you won't invest in a deal on preferred returns. So this is something that I've had multiple conversations with in the last 6 months, 9 months, of other operators who have a long-term perspective of shifting away from preferred returns just because, or starting them, let's say the business plan is a 12-month business plan, they'll start the preferred returns in month 18 because it's an easier transition in. Mm-hmm. Now, honestly, if you're investing on cash with 8% in year one, that's probably not going to be much of an issue. Yeah, your pref is not even a thing. But in your sense, I just want to hear your take on, because I think in 5 to 10 years, preferred returns are not going to be as common as they were in 2018-19.
Wow, interesting. Okay.
So I just wanted your take on it, where if you really do the numbers, I've analyzed deals from a preferred return perspective. If you remove it, it's a fractional off, but then I feel like it just aligns so much better for a holder period, for a longer hold period.
Yeah.
So what are your thoughts on it?
Yeah, and Dennis, your points you raise are very valid, and frankly, one of the things I'm always concerned about is not necessarily maximizing my profit as an investor, but making sure it's a balanced scenario for myself and the sponsor. I want the sponsor to be very motivated to actually not only operate the property well, but be in it for the long term, especially on a 10-year term. But so it's funny because I think when I tell a lot of people I have a mandatory preferred return, they assume that means I'm looking for a minimum return level. But that's actually not true. The reason why I'm looking for preferred return is actually for downside risk mitigation. It's actually about the downside, not the upside for me. So what I mean by that is that let's say I'm in a deal and it's 95% occupied multifamily stabilized building in a good location, and something happens in year 2 or year 3, and the cash flow goes from 9% to 4%. Okay. I'm in this for the cash flow, right? I'm not in it for appreciation, anything like that. So that is way underperforming. The problem is without the preferred return, they're just get to the 4% and go on. And maybe next year it'll be 6%. But I have no downside risk protection without the preferred return. With the preferred return, they're going to have to catch me up at some point. And granted, there's time value money and all kinds of challenges associated with that. But at a bare minimum, they're going to now owe me 4% preferred return from the 4 to the 8 that year. And then it's going to start to add up. And so essentially, it's basically, in my opinion, going to incentivize the sponsor more to keep the cash flow where it needs to be, because they will be falling further and further behind if they don't. And I'm focused on the cash flow. Whereas without the preferred return, the sponsor, in my opinion, is not nearly as incentivized to get the cash flow back up to where it needs to be in the next year. And so it's a downside risk mitigation in terms of how I look at it, not an upside thing that I'm looking at.
So devil's advocate on this is that, let's say in year 2, an event, let's say a fire, takes out 20% of the units, right?
Yep.
With a preferred return in place, the distributions either get stopped or whatever it is. Yep. Now you're looking at, let's say, year 3 or year 4. It's a great asset, great location. Nothing's fundamentally changed, but now the syndicator or the operator is in the hole, let's say 12, 13, 14%. And realistically speaking, it would take them year 7 and 8 to get out of the hole. So they're now, all of a sudden, they would have never thought to sell the asset, and it's a great asset. But now, all of a sudden, it might push them over the line to actually sell it at that point. Yeah. And I think we saw tons of that in 18 and 19, where how many of those operators would love their assets back that they sold in 20 and 21. And now they don't have a deal to do, but those are the greatest assets in the world in 18, and they all sold them in 20 just so they could get their majority of the returns.
Yeah, it's funny because, and I don't normally think of it to this degree from the operator side, but I will say that if, let's say there is a fire, and there's always, I can tell you 20 ways a deal can go bad. That's one of them, right? Because then the fire happens, knocks out 50% of your building, the insurance doesn't pay, you're now suing the insurance for 5 years. Meanwhile, property's foreclosed and you end up losing with the insurance and you've come out of pocket for attorney money, right? So like I can give you all these scenarios, right? So there's all these 1% risks. That's why you should never assume that there's a lot of different risks that can happen. And so in that scenario, if you told me 20% of the property was offline, and the sponsor decides to sell because they're behind the preferred return, I'm actually totally okay with that, because they're still going to have to make up that loss of cash flow to me before they take their profit at the end, because I'm going in based on a projected performance. And so I guess what you're telling me is that you don't think that the investor should be ahead of the sponsor in the event that something doesn't go as planned.
No, I just don't. So for me, I find that there's not a world full of great assets at a great price. So when you do get one, I feel like the operator should be aligned with the investors to do whatever they take to really maximize the value of that property. And sometimes you need that 10 years to maximize it. So when you're selling in year 4 just to pay back, and what is your return? Let's say in your situation, right?
Yep.
Year 2 fire, year 4 they sell. They give you all your preferred. Okay, you made 32% on your money for 4 years. Versus if you hold it for 10 years, you're going to get a 2.5, 2.8, whatever it is. And it's going to be more stable cash flow once it's stabilized. So I think not the fact that, look, I come from an investor background. Investors always come first, but not at the point where you're going to be sacrificing the quality of the asset, not really the operator's bottom line, but getting rid of a good asset prematurely.
Yeah, but I still say, so hearing all that again, so like for me, the preferred return protected me from the fact that there was an unexpected event and now you're not going to hit projections as an operator. And by selling early, I'm still going to have to be made up for that because there's going to be preferred return in arrears. So to me, the preferred return did its job. Now, if you told me I'm out of the deal at year 4 instead of year 10, and the deal would have been better for me to stay in 10 years, my answer to you is, well, the risk mitigation worked. And you're not going to be in a 10, it's not perfect. You're never in a deal for 10 years exactly often. Sometimes they say like year 7, sometimes it's year 15 or 20. Like it really depends, right? There's a lot of factors. But to me, the risk mitigation, the preferred return did its job in that scenario. And it may have not had an optimal long-term outcome, but it actually protected me. And that's why I'm saying like that preferred return is all about the downside risk mitigation. It's not necessarily about increasing the returns or maximizing the returns for me.
Got it. Okay, no, that's a great perspective, and thanks for sharing. So it's basically like your insurance policy as a LP.
Exactly. Yeah. Yeah. I think for me, it's like a non-starter. Like it's a mandatory insurance policy to have. Everyone's different.